Thank you very much for joining. We've got a fantastic webinar today with a great group joining us. Before I get to the introductions for everybody, I'll just say that the topic for today is Reg A distribution channels. It's probably the biggest question that I get personally when talking to issuers is, what makes a good, what separates a good Reg A from a not so good Reg A? And the answer is really a great distribution strategy. And the two people on the call today or on the webinar today are two of the best in that area to shed some light. Quick disclaimer for everybody. And why don't we move into the introductions? So first up, we've got Don Yocham. Don is the Executive Director for the National Institute of Cannabis Investors and Director of Cannabis Investing Research for Money Map Press. Before starting his role with the Institute, he was the head of private deals for the publication Cannabis Venture Syndicate. From his first foray into the trading pits of Chicago to introducing institutional investors to entirely new markets in the early 2000s, he's pretty much covered the entire field of investing in his 25-year career. In the depths of the financial crisis, when the typical investor had lost more than half of their money, his portfolios were up. Investors were sitting on a pile of money 2.5 times larger than your typical stock investor. And while most hedge funds struggled through the crash, he handily beat the vast majority of them. He put the same insight to work for a regional bank, protecting 100% of its revenue loss when the Fed started aggressively cutting interest rates in response to the crisis. This added a few $1 million to the bottom line and saved a lot of jobs. He spent the last few years as an agent of change in the financial industry, managing investors' money at firms with assets under management ranging from $250 million up to $60 billion. And for the last 18 months, he's been working behind the scenes at NICI, flying around the country, meeting with insiders, talking to CEOs, and looking for the biggest and best private deals for Cannabis Venture Syndicate. Now he's brought his skills and expertise to all members of the National Institute for Cannabis Investors. So a big welcome to Don. Thank you for joining. And also on our panel is Ryan Bradford, Director of Digital Marketing at CDMG, one of the bigger names in the Reg A marketing space. Ryan is one of the premier digital marketing experts in highly regulated sectors. He brings with him over 10 years of marketing experience in building and implementing highly successful multi-channel marketing campaigns. These campaigns span across recruiting, real estate, SaaS, nutraceuticals, e-commerce, crypto, financial, and other products and services. Ryan has received educational training and certificates from Google, Facebook, HubSpot, the American Marketing Association, and numerous universities ranging from UX design, analytics, channel integration, optimization, and much more. Ryan's contextual data-driven approach to marketing made him the ideal person to run CDMG's digital marketing operations. Paired with CDMG's background of multi-channel marketing with a data-first approach over the last 4 decades, they strive to provide clients with results. CDMG has been one of the top marketing agencies for Reg CF, Reg A, Reg D campaigns since the implementation of the Job Act. So thank you and welcome to Ryan and Don. That was those were some extensive bios and great to have you here. I will take a back seat, but I'll start asking some questions and we'll get into it. First off, Don, I'll start with you. The newsletter is one of the most elusive and unique channels in the capital markets, especially in the retail capital raising sector, like Reg A and stuff like that. How have stock or investment newsletters changed, over the last 5 to 10 years as we've entered into a digital age?
I've only been in it for 3, so I can't tell you what it was like 5, 10 years ago. I know now that there has been quite a few, pretty significant evolution, and in a way, it kind of mirrors money management. Through the 90s and most of the 2000s, you lived and died by your track record, right? And so you were always selling performance to the clients. But there's been in institutional asset management, wealth management, advisory work, that sort of thing, there's been a pretty significant shift to just the overall value of the relationship. the value proposition behind building relationships with the subscribers or with your clients, right? In that case, and you are starting to see that now in the newsletter. It's early, it's nascent. Certainly a lot of newsletters have always is really hinged on that building that relationship. I wouldn't say a lot, but a few. Now that you're starting to see a lot more of that. Not that people aren't, because there's much more to it, right? And you're always going to have volatility, time frames and that sort of thing that are unique to the individual, and you can never look all the way through. But it's really about, but building those relationships makes it a lot easier to weather that kind of turmoil, and kind of it makes it easier keeping focused on the long term, and you build a relationship on trust rather than, hey, just what's in it for me right now. So, I think that's a big shift.
Okay, that's fantastic. And now part two, which is probably a lot of what our listeners are looking into. What can issuers do to get their deals newsletter ready, right? Like, what are you looking for when you look at a potential deal for one of your newsletters?
Right. I look at news, whether I'm recommending it in a newsletter, or if I was investing for a fund, or on the behalf of a pension plan or something like that. It's all exactly the same, right? And that comes down into the due diligence of the deal. So number one is the quality of the management team, especially startups, early stage. 90% of the value and the success is going to be based on the individuals. Now, they don't have to be they don't always have to be a serial entrepreneur that, this is their fifth deal. And, it doesn't always have to be that way. There's, people can be their first time startup and be very good at it, right? They can know how to deliver value. They can have a clear, concise idea. So it doesn't have to be the repeat entrepreneur, but you want a very high quality management team. Number two is a cap structure, right? And that's where you can find out, and what makes them high quality, the biggest thing is to make sure that they understand they're creating value for shareholders, not just for themselves. So the second part to that is you can take a look at looking at the cap table. How much money have they raised? Who have they raised it from? How diluted have they managed? How much have they diluted themselves in the process of trying to raise money? And if that dilution has gone too far, well, they don't really have a whole lot of skin in the game, right? So that's number two. And then, of course, beyond that, what's the idea? Is it a focused business proposition? What likelihood do they have of coming with it? And then you see, whether then as you press them on that idea, and then if the other things are right, they can either hang with conversation, and it's clear that they've got a focused set of products, not trying to do all sorts of things, right? Opportunities are massive, and sometimes it's hard to sort out which is going to be the biggest and best opportunity. The worst thing you can do is try to play them all. I think as a founder, and so you want a very focused idea. So to me, those are kind of the top three things that I look for.
Perfect. And just sort of adding on to that, I assume you see a lot of, you mentioned early stage companies, and that's a lot of what we see in Reg A, people with a great idea, maybe, but not a fully formed story. How much do you work with the issuers and, seeing something that sort of fits that criteria of a high quality management team, the dilution and their previous money raising, fits your criteria, and sort of a focused plan to sort of help to craft that story that's going to really resonate?
Well, so I think it depends on, how much value I really see in the idea, right? And, if there's really something there, and to be clear, as an investment newsletter, I'm not a paid or consultant by the company. I'm not actually, it's just, I'm there totally 100% on behalf of the subscribers. Now, of course, they ask, right? They're curious. They want to know, what works about, what they have. It's an open dialogue, right? I got a lot of experience, so we share those things. And my feedback is usually pretty straightforward, and then they can either infer from that, or I'll tell them, hey, this is what we like to see, right? And sometimes they get to work and fix those things. Whether it's, we've had them recap the cap table, which is pretty significant. Have had companies that, sometimes it's focusing their messaging, right? But it rarely has anything to do with the actual business strategy. But there's, a lot of innovators, founders, so they don't have the capital market side of it is hard, right? It's a whole skill set in and of itself. You've seen this across the entire cannabis industry. And the guys that are skillful at the capital market side and running the company are the ones that are seeing the most success. That's, for somebody that's either been an engineer their whole life, right? Or whatever it is, it's a completely different language, right? And they may be able to run it just great, but they're scared about the whole process, right? They don't want to be taken advantage of. That's so that's a big part of the deal there.
Awesome. And Ryan, let's move it over to you. One of the things that has happened is with reggae marketing. There's so many channels that you can go out with digital marketing, right? Facebook, email, Google, LinkedIn, promoted content, Reddit, you name it. There's an avenue for promoting a reggae, even TikTok now in some cases that we see, and we have seen some issuers incredibly successful in some channels and others not. How do you plan your channel strategy when looking at a new raise, and how has that changed over time?
Yeah, I think that this is really intriguing because there is a ton of channels, and there's new channels every day. We get questions from our clients all the time. How come I'm not on this? How come I'm not on this platform? And a lot of our basic building of a campaign is all focused in on how do we attract your ideal investor? How do we build that investor persona that is going to be an investor that's more likely to take an action on your investment opportunity, on that issuance? So we really are always going in, we're testing these different platforms to see which audiences resonate well with others. We're working with our partners to make sure that we're understanding what are the demographics, the age groups that are using these products, the regions that they're really big. How can we more effectively and more efficiently target our target audience? And so once we get all that kind of built out and get that understanding, we really grow our base data, that investor persona or personas, because there's sometimes more than one person or one type of person. And we build that data out with a focus on transactional metadata, as well as actions and in-market audiences and affinity audiences to really maximize our strategy on a client basis. Because no two raises are going to be the same. One client might have a raise that does extremely well on Google, and we might have another client that does extremely well on Facebook. We just don't know until we start testing, presenting different messages in front of individuals. And then once we find that right audience and that right resonating message, then that's when we turn up the heat as it get more capital coming in.
Okay. And so I've seen issuers go at it in a couple of different ways. Do you try to build out your potential segmentation and your potential, investor, like what your sort of ideal investor is, and then start trialing it slowly into a couple of different channels, testing the data? Or are you, do you ever do a situation where you kind of blast out across everything and let the data sort of lead you in the direction afterwards?
Yeah, so there's a lot of different approaches to campaigns, and I've heard quite a few throughout my years. I am a data-first, data-driven person, and that is what our agency is all about. So we are building that baseline data on the bottom and that baseline audience on the bottom to be more successful in your campaign. That data is going to dictate what we do creatively. That data is going to dictate what platforms we use. So we're going to build that out first because that's what's going to help you be successful. We don't want to shotgun a message out there because it's very difficult when you start amplifying and shotgunning it out there to really drive home and be effective with your spend earlier on. And yeah, you might get the best sources eventually, but it's going to be very difficult for you to cut through the noise to get to that place to say, hey, this was really successful and I'm ready to do it more. And these are the pieces that made it successful.
Awesome. Awesome. So Don, going back to you, we talked a lot about sort of what you're looking for when you take a look at a potential issuer for a newsletter. You know, going out and thinking about the subscriber base. You know, when you're starting to craft the message that you're going to send out to your subscriber base, what are the key things that you're thinking about that you find resonate really well when you're presenting a deal?
Let's see. So, I mean, ultimately, there's, what we do is in our offer is to, promise we'll deliver X number of deals, that sort of thing, right? And so, right there is a, for fulfillment purposes, it's 100%, just being a solid opportunity, right? Now, that solid has to be a pretty decent, the perspective for pretty decent payoff, simply because of the liquidity premium by being locked up. You don't know how long it's going to be before they go public. Scrambling to go public as fast as possible is actually a red flag in my mind, right? You want to be mature. The company needs to be mature enough to be on public markets, and not just giving them an avenue to cash out for the for the founders and early investors. And the retail tendency is to want to have a quick and early exit, right? So I certainly coach and encourage, a much longer term perspective. Private equity, because this is the idea is to be a private equity investor. Well, a private equity investor, the typical exit is 3 to 5 years, right, on average, that's on the order of 5x, 10x, is kind of where they set their sights early on, right? That's on the institutional side. And there's no magic that happens to a company by the way that they raise money, right? So all of those principles are still there. I mean, that's how you capture that liquidity premium. That's a big reason it's there in the first place. But every day, if we run across one that has a really compelling story, excitement can come from a whole lot of reasons, right? It can be the quality in the background of the founder. It can be the next thing that they're going to work on. Maybe they just won a massive contract. All of those things, or there's a series of prospective contracts, right, that haven't been priced into the deal yet. Some kind of expansion. That is, those are all very exciting things and kind of help hasten the exit strategy, right? Or the ultimate payoff, right? So and those are the ones that we go through extra efforts to draw in new subscribers, with a story like that, because it can attract their attention very quickly.
Right. And
one is just making sure people get fulfilled with really great deals, that stand a great chance, in capital markets and in the world.
Awesome. And you sort of mentioned one thing that I just maybe I don't know if it is a quick answer, but one of the things that we get asked a lot of, and you mentioned rushing to go public, the liquidity timeline for a Reg A type of deal, for this kind of retail capital deal. Do you find that there is sort of like a time horizon for liquidity that your subscribers are expecting, or is it relatively open?
Well, I mean, so yeah, there's definitely one that they're expecting, right? But that may work counter to their purposes. And that's where you have to have a really good relationship with your subscribers and make it clear to them, here's the trade-off, right? It just to say, hey, I want a private deal, but I got to get my money out in 6 months, right? Mm-hmm. You're going into it all wrong, right? That's not a deal that you should be banking, right? Yeah, so I mean, it's that those are all just the expectations. I mean, investment management, and kind of along with those related, like we started with the way it's changed, relationship management, investment management, and regardless of the channel, get your advice, is all about setting expectations first, right? That is the hardest one. It needs the most reminding. Every professional investment manager in the world, gets very familiar with that, right? It's not just about a good trade idea. You got to really manage expectations, because things don't work out exactly the way that you want them to. And yeah, so it's that conversation between who doesn't want 5 times their money sooner, right? I mean, that's time value of money, right? But then this isn't the route if you're looking for a quick payoff. If you need a quick payoff, right? You can be looking for a quick payoff and be able to survive it if you don't get it. That's fine, right? But if you need a quick payoff, this is probably not the way to make sure you pay December's rent or something like that.
Right. Awesome. Thank you. Ryan, sort of, I mean, we'll sort of go back to the story. Like, when you're working with a new issuer and you're helping to craft the story, are there specific things, that you're highlighting? And also, possibly more importantly, like, what are you trying to avoid when telling an issuer, when crafting and telling an issuer story, and how does that change from channel to channel, or does it?
Yeah. So I think Don hit on quite a few of them, but I think that there is a lot of things that we want to make sure that we're trying to encapsulate when we're building out copy, when we're building out that story. We really want to make sure that we are informing investors on a few things, like how does a company fit into a niche. We want to know, so that way we can show that investor that, hey, there's an audience for this. There's a piece here for that. We also want to make sure that we're communicating over how the company intends to be profitable eventually. That's a step that typically gets overlooked. There's not an outline or a pathway to actually become a profitable company. And that message is actually something that's very important to investors. They want to know, hey, am I going to get my money back on this investment? Is there an end game? Is there I know that there's a risk, but what's my win if this pans out? So we want to make sure that we're able to communicate that over. And another big one that kind of gets overlooked a lot of times is scalability of products and ideas. Typically we get a lot of clients that come to us, or potential clients that come to us, that just don't have the scalability to be able to handle the type of raise that we're looking at. They don't have the team, they don't have the right niche, they don't have an audience that they can expand to make that jump into a Reg A. And they're better suited for Reg CF, or even like a crowdfunding raise. So we have those hard conversations sometimes to say, hey, we need to make sure that we're presenting that message. And so one of the other things that we typically see a lot with a lot of our clients is that our clients are really close to what they do. That's what makes them great at what they're doing. That's what makes it exciting, and that's what makes the startup run, is having great management that's very involved and very ingrained in the process. But we typically can see that a lot of times when writing copy, our clients can get bogged down with a lot of the details, and those details can get overwhelming at times. We typically write our copy at a lower reading level, just because it's easier. We don't want to get bogged down with a lot of details. And it can be hard with some of these raises when you have a very technical raise, when you have a very technical product. But we want to make sure that we're finding ways to be compelling with our copy, but also give them something they can take action.
Awesome. That's a great answer. And we've got a couple of questions from the audience, and I'm just realizing now it's 12:26 and this is a half an hour webinar. So we're very closely running up on time. It's been a great conversation so far. If anybody from the audience has additional questions, please feel free to put them into the chat. But the question that sort of seemingly comes up every single time we do it, what is your take on valuation, price structure, and how it impacts the deal, and possibly the story and the channels that you go out with. I'll start with Don, and then maybe Ryan, you can weigh in afterwards.
Right. Well, and something that I kind of could have mentioned this earlier, or goes with my answer before, is, number one, is it an investable business, right? Reg CF and Reg CF channels particularly, they're easy. Almost anybody can do it, right? But a lot of businesses kind of just pay the owners a reasonable income, right? And the average, I think the average take-home pay for a business owner is something like $70,000. So there's not enough value being created to share with a lot of investors, right? If you have somebody, family owns, just as a very simple example, if somebody owns a Subway shop franchise, right, and they got to say they want investors to, I don't know, build another one, right? That's not really an investable idea. It may make money for them, and it could work for the founder, the entrepreneur, whatever, the franchisee, but there's not enough juice there for to pay out shareholders and the employees and the owner, right? Now, if somebody said, boy, I've done an incredible job on 3 Subway franchises, I've got a plan here to open up 30, I'd like to raise money from outside investors to help me do that. And it turns out I can run these things awesome, right? Now that all of a sudden, now you've got something that scales. What was the other part of your question? I'm sorry, that was, and valuation. Okay. Mm-hmm. And there's really, a couple tiers, right? The smaller companies, like a company raising, pre-revention, looking to raise $5 million, or sometimes even $10 million. There's not enough information there to really argue hard about the valuation, right? Somebody raising $1 to $5 million, let's say if somebody's raising $1 million, right? It kind of has to be worth $5 million at a minimum. If it's going to pay out, hopefully, if it's going to work, it needs to ultimately work to 50. So if they have a path that you think that will get them to 50, you're not going to quibble about a $5 million valuation versus a $7 million valuation, right? There's just these. But if you're valued at 5 million and you raise 5 million, well, you've diluted yourself completely, right? So there's this balance between what valuation keeps enough relative to how much they're looking to raise, keeps the skin in the game. And then once you get further down the line, you can start having more rational argument. That's why a lot of private companies raise money with convertible debt, because you don't really have to have that argument, right? It converts at some level once you raise a reasonable amount of money and you develop to a stage, to have a meaningful conversation about valuation. And then you start applying metrics, whether it's revenue or, what kind of profitability they're going to have, what's the growth rate. Then you can have a meaningful conversation about valuation. But pretty soon, if you got a great team with a great idea and you think it's going to be worth a lot, don't squeeze them. You don't want to squeeze them too much on the value, because you got to, you got to leave something in there for them, and ultimately, if it works out, which is the only reason that you're investing in the first place, those are kind of the big, parameters that I'm trying to steer within when I think about valuation.
Awesome. And Ryan, why don't you weigh in? We'll keep it open for another minute or two, and you can add your points on valuation and pricing for the deal.
Yeah, I'll just kind of highlight some real quick things to kind of keep in mind. Is that, it's just like any other kind of consumer product out there. It has to have a good valuation. Buyers are going to have price sensitivity. They're going to do their research to say, hey, is this a deal or not? We need to be able to present that as a deal. Valuation, price structure, everything inside of here is something that impacts your campaign down the line. So really setting in and making sure that you have that. And also, we really go through and make sure that you're looking at that valuation from a perception of the psychology of the buyer persona and the buyer behavior. So you want to make sure that you're understanding, does this make sense? Does this line up? Am I giving them something that they can look at it and they can go, A, this is a deal, and B, this is something I can see myself making money off of.
Awesome. Well, thank you so much, Don. Thank you, Ryan. Thank you for everybody who attended today. The replay will be sent out to everybody afterwards. If you have any questions, don't hesitate to reach out. You can connect with me, Mike at DealMaker, and I can, answer the question and put you in touch with Don and Ryan if you need it. And yeah, thank you very much. And thank you, Don and Ryan.
Thank you, Michael. Appreciate it.
All right.
It's been great.
Yep. Thank you, guys.